What if I told you the government is literally allowing you to pocket thousands of dollars in stock profits this year, completely tax-free? And almost nobody your age is taking advantage of it. There's a legal provision in the tax code, not some sketchy loophole, an actual written-in-stone rule, that lets you sell up to $44,625 in long-term capital gains in 2023 and pay exactly $0 in federal taxes on that money. Zero. Not reduced, not deferred, eliminated. And here's what's almost frustrating. Most 28-year-olds already qualify for this. They just don't know it exists. So instead, they sit on investments they want to sell, afraid of the tax hit, or worse, they sell and unnecessarily hand over money they could have kept. By the end of this video, you'll know exactly how this bracket works, whether you qualify, and the specific moves to make before December 31st to take full advantage. This one piece of information could literally save you thousands. Let's start with something most people get wrong about capital gains taxes. When most people hear capital gains tax, their brain immediately jumps to a fixed rate. They think it's like income tax. You make money, you owe a percentage. Simple, but that's not how it works. Capital gains actually operate on a tiered system, and the bottom tier, it's 0%. The IRS has three capital gains brackets: 0%, 15%, and 20%. Which bracket you fall into depends entirely on your taxable income, not your gross income, not what shows up on your pay stub, your taxable income. That's the number on your tax return after all deductions and adjustments. For the 2023 tax year, if your taxable income is $44,625 or less for a single filer, your long-term capital gains tax rate is 0%. Married filing jointly, that number jumps to $89,250. Head of household, $59,750. Now, I know what some of you are thinking. That's great, but I make more than $44,000 a year at my job. Hold on. That's where the magic of taxable income versus gross income comes in. Let's say you're 28, single, and you make $65,000 a year at your job. Sounds like you're over the threshold, right? Not so fast. First, subtract the standard deduction. For 2023, that's $13,850 for single filers. So your taxable income is already down to $51,150, still over the limit. But what if you contributed to a traditional IRA or a 401k this year? Those contributions reduce your taxable income too. Let's say you put $6,000 into a traditional IRA and you're already contributing to your 401k at work. Maybe that knocks another $5,000 off your taxable income through pre-tax payroll deductions. Now you're at roughly $40,150 in taxable income. Suddenly you have room. You could realize up to $4,475 in capital gains and still pay absolutely nothing in federal taxes on those gains. But here's where it gets even better. Let's go back to that $44,625 number. That's not how much stock you can sell. That's how much profit you can realize. There's a massive difference. If you invested $20,000 in an S&P 500 index fund 2 years ago and it's now worth $44,625, your gain is $24,625, not $44,625. You could sell the entire position and owe zero federal taxes because your profit is under the threshold. This is why understanding the mechanics matters. You don't need to have only $44,625 in total investments. You can have hundreds of thousands invested. The threshold only applies to the gains you choose to realize in a given year. So let's talk about strategy. There's a specific move that financially savvy people use called tax gain harvesting, and it's absurdly powerful when you're in this 0% bracket. Think of it like pruning a tree. You're selectively selling positions with gains to lock in those gains tax-free, then you can immediately rebuy the same investments if you want. There's no wash sale rule for gains. That only applies to losses. So you can sell a stock or ETF at a gain, realize that gain tax-free, and buy it right back the next day if you want. Why would you do this? 2 reasons. First, you're essentially resetting your cost basis higher. If you bought shares at $50 and they're now worth $80 and you sell and rebuy at $80, your new cost basis is $80. That means less gain to tax in the future when you might be in a higher bracket. Second, and this is the one most people miss, your income probably won't stay this low forever. At 28, you're likely in your earning growth phase. 5 years from now, 10 years from now, you might be making significantly more. The 0% capital gains bracket might not be available to you then. Use it while you have it. Now, a few important caveats. First, this only applies to long-term capital gains. That means investments you've held for more than 1 year. If you bought a stock 6 months ago and sell it for a profit, that's a short-term gain and it's taxed at your ordinary income rate. The 0% bracket doesn't help you there. Second, this is federal tax only. Some states tax capital gains differently, so you'll want to check your specific state rules. Third, the gains you realize do count as income for determining your bracket. So if you're at $40,000 in taxable income and you realize $5,000 in gains, you need to account for the fact that those gains pushed your income up. Actually, let me clarify that because it trips people up. Your $44,625 threshold includes your regular taxable income plus your long-term capital gains. So if your taxable income from your job is $30,000, you have $14,625 of headroom for capital gains before you hit the limit. It's not a separate bucket. It's a combined calculation. Let's work through a real example. Meet the profile. 28 years old, single, making $55,000 gross salary, contributes $5,000 to a 401k, takes the $13,850 standard deduction. That brings taxable income down to about $36,150. Now you have $8,475 of room left in the 0% bracket. Let's say you have some shares of an ETF you bought 3 years ago. You invested $10,000 and it's now worth $18,475. Your gain is $8,475. You could sell the entire position, pocket the $18,475 cash, and owe exactly $0 in federal capital gains taxes. Then rebuy the ETF tomorrow if you want to stay invested. Or maybe you don't even have specific gains you want to realize. That's fine too. The point is, knowing this tool exists so you can use it when the opportunity presents itself. Maybe you want to rebalance your portfolio. Maybe you want to cash out some individual stock picks that did well and move into index funds. Maybe you just want some cash. This bracket gives you flexibility. And here's something that really gets me. Most financial advice aimed at people in their 20s focuses exclusively on contributing to retirement accounts. Put money in your 401k. Max out your Roth IRA. And those are great strategies, don't get me wrong, but this capital gains strategy is about what happens outside those accounts, in your regular taxable brokerage account. If you've been investing in a regular brokerage account, maybe you use Robinhood, Fidelity, Vanguard, whatever, this applies to you. Those contributions didn't give you a tax deduction. But the gains in that account can still be tax-free if you play it right. It's like a secret Roth IRA that nobody told you about. The window for the 2023 tax year closes on December 31st. Stock sales are taxed based on the trade date, not the settlement date. So if you want to take advantage of this for the current tax year, you need to execute your sells before the market closes on the last trading day of the year. Don't wait until April to think about this. By then, it's too late. The transaction has to happen in the calendar year. Pull up your brokerage account now. Look at your unrealized gains. Look at positions you've held for more than a year. Do the math on your taxable income. See if you have room in that 0% bracket. And if you realize you've been leaving money on the table in previous years because you didn't know about this, don't beat yourself up. Almost nobody talks about this strategy for people in their 20s. It's usually pitched as a retirement strategy for people in their 60s who have low income after they stop working. But the math works the same at 28 as it does at 68. Income is income. Let's recap. If your taxable income is under $44,625, as a single filer, your long-term capital gains rate is 0%. That means you can sell investments you've held for over a year and pay no federal tax on the profits. You can use this to reset your cost basis, rebalance your portfolio, or simply access cash without a tax penalty. This is one of those strategies that seems small in isolation, but over a decade of investing, it can save you tens of thousands of dollars. Every dollar you don't pay in taxes is a dollar that stays invested and compounds. That's the real game. If this was helpful, there's more on the channel. I break down strategies like this regularly. The stuff that actually moves the needle on your financial life without requiring you to be a Wall Street expert. Take care of your money, and it'll take care of you.